Hi, Daniel. How you doing?
Good, how are you?
Good. Could you hold the fort for me for a few minutes? 2 minutes, be
Sure.
right back.
All right.
All right. I come to you with clean hands, Daniel. It's just us so far?
Yeah, I guess so.
Okay. How'd you do in chapter 9? You get a sense of the present value, how to use the tables?
Yeah, I feel good about that now.
Okay. Yeah, we're going into two. This is definitely 9 and 10 are two tough little chapters here. But as long as you understand the concept of how to use the table, that's a big step in the right direction.
All right.
All right, I might as well put up on the screen what I want. All right, I didn't want to stop the recording. Share screen. Okay. I think you were the guy showing me how to do this efficiently the other day, right? Am I wrong?
Uh-huh.
Okay, don't tell me. I'm going to open up the file and then share it. That's all I have to do, right? I think. Okay, where's my file? Come on. Chapter 10. Chapter 10. Okay, hold on. You don't see it yet, right?
Mm-mm.
Okay, here we go. Now it should pop, huh? Okay, all right, Daniel. I'm gonna have to ask you to guide me through this again.
Just share whatever screen you have. So just share your desktop screen.
Yeah, yeah, it's showing like 6 files up there right now, but not the one I want.
Well, just click any one of them.
Okay, well, that's one we'll be using later in the class.
And then
And
go
now,
ahead and minimize it.
okay. And get down to the desktop, I think you said?
Yep.
Okay, and then while on the desktop, open up said file, right?
Yes.
It should be easy to do. That's right here. See it now?
No, I guess I'm wrong.
Okay, no, hold on. We'll figure this out. We'll figure this out.
Yeah.
I mean, I haven't failed yet to get this thing up here.
I think last time you shared your blank desktop and that worked.
Okay, so
So if that's one of the options, click the blank desktop.
okay, hold on. Okay, now I am in my desktop. So maybe save it to the desktop is what we're suggesting.
No, why don't you stop sharing?
Okay. Hold on. Stop share. Okay, I stop share.
And then when you hit share video, is one of your options just your desktop?
When I hit share screen, I get 5 or 6 items. Let me try this. I thought this is the way I succeeded the other day. I mean, I just did this. Oh boy. Okay, now I'm in the share screen mode. When I click on this class, it should start sharing. Oops, get out of there. I have the file open. Maybe I'll close it. There's the file in front of me. I can see it, you can't. I come here and I go share. Success, I think. Please tell me you see it.
Yeah, I see it. Awesome.
I think we have user error here. Slideshow, set up. Whoop, not that. We don't want to set up a slideshow. Customize it. Custom. It's all about me, the way I want it, okay?
All right.
Okay. So it looks like it's just the two of us, Daniel, but that's okay, you know. We can really hit this bat this out of the park now, okay?
Cool.
Bonds. A bond is a debt. It's borrowing money. It's borrowing money under time, and there are going to be interest payments to be made in the future. And the principal amount you borrowed needs to be paid in the future. You borrow $100,000 from Coca-Cola. They hand you the 100,000, but you then have to come up with the present value of that investment. And that's what we're going to do here. Companies can raise money by debt or equity. The next chapter is all about equity, raising money with a stock issue. They each have advantages and disadvantages, okay? Debt you have to pay back, huh? Who knew? Debt you have to pay back, and you have to pay all the interest. And if you are going out of business, note holders collect before accounts payable, or what are known as non-secured creditors, okay? So a bond is a debt, it's an IOU. And this, I think, is a little bit interesting, the characteristics of the bond, okay? The goods and the bads. The advantage is if you borrow money, you're not giving the company away like you do when you issue stock. When you issue stock, by definition, you're giving away shares of the company to somebody else. Bond, the interest expense at least is tax deductible. And guess what? The impact on earnings can be positive if you borrow low and invest high. I don't think you needed to take a college class to know that, right, Daniel? But
yeah,
if you can borrow money at 2% and you know you can get 4% from another bank, you do it. But the problem with a bond, bankruptcy will kill you. You have to pay everything back. If you issue billions of dollars in a stock issue and the company flops, nobody can come after you. You have the corporate shield. And disadvantage of the bonds is, your cash flow is reduced, obviously. You spent money. Okay, here are the terms that we need to really understand. And this is what a bond used to look like in the old days. It looks like a stock certificate. It says $1,000, then somewhere in here it explains what the bond is for. This is from the Midland Railroad Company. Perhaps they were borrowing $1,000 to build another train station back in the day. So on this document you see here is going to be the principal, par value, maturity value, okay? Face value is the preferred term, at least I prefer face value. They're all the same, maturity value, par value. Principal is the amount you borrowed. It's probably going to be a big number ending in some zeros. Nobody has ever issued a bond to the world and said, we want to borrow $993,618.12. No, it's always like 100,000, 10,000, whatever. So that's a little tip, help you if you get confused between the net book value and the principal. The coupon rate is simply the calculated rate that pays the interest. That is all the coupon rate is. This bond we see here it says $1,000. If it was 8%, it means that every year they pay $80 in interest. Every year until the bond matures, meaning it ends, the life ends.
And it's the same value every period.
Yep, it's an annuity. I'm so glad you asked that question. You hear that, class, when you finally look at this? Yes, it's an annuity that we learned about in the prior chapter, okay?
Mm,
So when we get the present value of a bond, we have to get two things, the principal and the annuity. And whatever the coupon rate calculation is, that's the annuity. In this case, I said 8% of 1,000, that's $80. That would be your annuity. We have something even more important, huh? The market rate, also known as the yield or effective interest rate. Effective interest rate. And this is going to come into play when we're going to use that rate when we go to the present value tables. Coupon rate, you just figure out the annuity amount. Market rate, you figure out the present value of that annuity, okay? So let's see what we have here. Different kinds of bonds. An indenture is a contract, okay? A debenture, they call them an unsecured bond, You come to my bank, Daniel, and you want to borrow $1,000. I look at you and I say, what are you doing, Daniel? You say, I'm going to college. I ask what the $1,000 is for. Well, I need to pay my last 6 months of tuition. I already have a job offer, blah, blah, blah. At that point, I'd probably loan you the money unsecured. But if someone else came to me and they wanted to borrow the money, 1,000, I look them over. Maybe I don't have the same high opinion. I said, yeah, I'll loan you that $1,000 as long as you let me hold your laptop computer till you pay me back. Collateral, in other words. You know that word, right? Collateral. Some bonds are callable, and you're going to get a couple questions on this callable bond. I borrow money from you for 30 years, a 30-year bond, okay? And when I borrowed the money, the interest rates were, say, 8%. And I pay 8% year after year for, say, the first 10 years. But the interest rates have been going way down. The interest rates are down to 2%. If the bond is callable, I can tell you, Daniel, I'm not going to make any more payments. Here is your money back, plus maybe a little bit of a penalty, and we're even. Callable bond, okay? I don't know why anybody would buy a callable bond, because usually you buy a bond because you want the interest. And the callable bond does not guarantee that. But I think with a callable bond, you get a little higher interest rate. A convertible bond, I don't hear this much about these guys anymore. Convertible bond means you buy a $1,000 bond from IBM. Then you look at IBM stock and you say, I'd rather have the stock than the bond. All you have to do is call IBM, say, take my bond, sell it, and buy an equal amount of stock. So these are multiple choice type questions we need to talk about. The prospectus is just the contract. Are you familiar with a prospectus? Have you heard that word before, Daniel?
Yeah, I read it in the chapter.
There you go. Prospectus. A company, when they borrow money, they don't just announce today we're borrowing $1 million. The prospectus is a little booklet, typically a pamphlet, if you will, and it describes how much they want to borrow, why they're borrowing it, what purpose, what interest rate. It's like an offer. Bonds have different ratings from high to low. Right now, you see these AAA high-grade investment bonds. You'll be lucky to get 2 or 3%. Because interest rates are very low and companies don't have to pay a lot to borrow these days. That's why it's a good time, people think, for companies to expand and, do things, build a factory, put people to work. But if you don't like the crummy 1% or 2%, I can hook you up right now with a bond that will pay 15%. Are you interested, Daniel? Pays 15%. Sounds good, right?
Yeah.
What's the problem with that bond, which would be rated D probably?
It might default.
Exactly right. If somebody is forced to pay 15% when the rest of the market's paying 2%, there's a reason for that, because everybody thinks they're too darn risky. And you might get lucky and collect 15% and survive. But you're right, they're probably going to go out of business and you'll take a bath, okay? And this is kind of interesting here. Take a look at the bond prices for 3 disparate companies. Apple pays 3.45%, which means you're going to get $3.45 in interest for every $100 you might buy in a bond. Amazon only pays $2.50. Walmart is sort of in the middle, and one matures a little further, a little shorter in the future than the other. And this is called the market yield. This is what it's really yielding in the marketplace right now. Okay.
Mhm.
And this part's a little bit confusing.
Yeah.
This yield is called the market rate. And you're going to use it when you go to the present value tables. You will never go anywhere without the market rate when you're in the present value tables. An easy
Okay.
mistake to make is grab the coupon rate, then you get all screwed.
Uh-huh.
So look at this, huh? Apple is paying $3.45. What's the rest of the market paying?
$3.29.
So look what their $100 bond is worth. My point is, and what we're going to learn in the next half hour or so, is that if people buy the Amazon bond, they're going to be willing to pay more than the $100 for it to get that 3.45% interest. Okay.
Mhm.
Walmart doesn't pay as high, but it's still above here. And their market price is 101.36 because the market rate's a little bit lower. Okay.
Mhm.
And now Amazon is not paying the market rate. So you're not going to pay $100. You're not going to pay $1,000 for that $100 bond. You're only going to pay $94.92. And these are the relationships we need to start understanding as we go through.
Yeah. I mean, I'm just confused because like, why wouldn't they just say we're gonna pay $3.45 for the $100 and leave it at that?
Well, that's the whole point. Okay, this is what we got to get you past the first little slip up here. They are going to pay the 3.54%. That's exactly what they're paying. But the market is only paying 3.29 now. So people who want this 3.545 are going to have to pay a little more for it. Now, let me go further. This chapter and in this course, we don't use the most important word in the world of bonds, and that's risk. It's risk. And that affects these yields too. These are just to get you to understand the difference between the coupon rate and the yield rate. And in our class, we are pretending that these bonds are all no risk. So you end up with the market rate no matter what happens.
Mhm.
And let me continue from there. And hopefully this be a little more clear. Hey, look at your bond note, huh? Face value, 10%, I'm sorry, 1,000, 10% interest paid semi-annually. So I guess that's $50 every 6 months if I do the math in my head, right? $100 a year. This bond looks like it's a 10-year bond. It begins on January 1st, 16, and expires at the end of the year 2025, or you could call it 1/1/26. Here is your red face value, maturity date, bond date. Okay. It's got everything associated with the bond. What it doesn't have are the external factors, the external paradigm that will affect how people treat this bond. And that is when it was issued, obviously, and the market interest rate. The market rate, what people are paying. What you're going to learn here is the market rate goes to the present value table. Let's understand this relationship, and it's just like anything else. If we'll start with the second one. If our stated rate, meaning the coupon rate, is 4% and the market rate is 5%, no one is going to give us $100. They're going to give us a lower number. And that's called issuing a bond at a discount. If we're paying more, people are willing to pay more, and we will issue it. It was called a premium. And if the stated rate is the same, makes the life easy. There's nothing to do. There's nothing to do in terms of a present value calculation. So what I really hope we can understand, you and everybody who'll be looking in later on, is by the end of this chapter, we're pretty good at computing the issue price of a bond, knowing that if the stated rate is less than what we're paying, we're not gonna get $100,000. We're gonna get 97 or something. The opposite,
Right.
if we're paying more, okay? So we
But
need to go ahead, Daniel, jump in.
but it's like, are you getting more money at the end of the bond's life if you get it for a discount?
Nope, you get the $100,000 in all cases.
So in all cases, all you're getting is $100,000.
No. I didn't say, in all cases, you're paying back 100,000, what I meant to say.
So, okay, so if you sell the bond, you're only ever gonna pay 100,000.
Yeah, we don't get involved in selling the bonds between periods. That's a whole other world there. But here, think of it this way. We had a stated rate that was less than the market, so we only got 95,000. We have to pay 100,000 at the end. The premium, we got 103,000 because we were paying higher interest. We pay the 100,000 at the end.
So are you getting more? You're getting an extra $3,000.
Yeah. And that's called a discount. And the extra 3,000 will be a discount. Less than 100,000 would be called, let me say that right. If you're paying more than the market rate, it's a premium. If it's less, it's called a discount. Which
So
means,
it just kind of varies depending on how the market's doing.
Absolutely, whatever the market was at that exact point in time.
So like when the coupon rate is basically the guaranteed amount of interest you're going to get paid, but that's
Exactly.
almost kind of just trying to like it's not like predicting, but it's like it's guaranteeing that payment, but then at the end of the life you pay off what it actually ended up being worth.
No, at the end you only pay off the $100,000. And that's what we're going to get involved now with these next couple of slides. In other words, when you got that money, you debited, let's say, 96,000 in cash, right? Because at a lousy rate. Debit cash 96,000, you were going to credit bonds payable for $100,000. And that 100,000 is never going to change. So the extra debit we need to balance is called a bond discount, which we will amortize over the life of the bond by turning it into interest expense. Think of a discount as interest expense that we got nailed with right at the beginning, and now we have to smooth it out over the life of the bond.
So I mean, I'm just confused. Like, why don't they just sell the bond? Why don't they always just match the bond to the market rate?
Because companies, if certain companies only match the market rate, but they're not a real stable company, no one's going to buy their bond. IBM wants to borrow $1,000. Everybody knows IBM's not going anywhere. But some little tiny company nobody knows wants to borrow $1,000. People say, well, I'm not going to borrow from you at the market rate when I can go to IBM and know my money is safe. I'll loan you money if you pay me 5%.
So it's an incentive to buy a discounted bond.
Nope, not for the buyer. Not for the buyer. The way this thing works here is when you're talking from the buyer's point of view, right, Daniel?
Yeah.
When a buyer buys a bond, they have no idea if the bond was, I don't want to say that. They don't care if that it was a discount or whatever. They're just paying the equal to the market rate in our class, because we're pretending that difference is there for a reason. They're going to pay us the market rate, and any difference between the market rate and the par value or the face value of the bond is, I'll use this word, like deferred interest. It's called the discount. And every period we're going to reduce that discount, and we're going to keep increasing what's called the net book value of the bond till we get up to 100,000. Now that's a mouthful just from this slide, huh?
Yeah.
All right, let's continue, and you jump in. Good questions. And this is the same thing. Coupon rate is 10%. I don't like that particular slide. Okay, here we go. Burlington issues 10,000 bonds having a stated rate of 10%, and the market rate is 10%. There is no present value calculation. There's nothing to amortize. It's this easy. Cash, bonds payable, we're done. How easy was that? How we can call the class off? Okay, because the
Yeah.
rates were the same. Okay, and we did a lot of this in chapter 9, whether you realize it or not. Okay, so now they issued it at par, and then at the end of the period, they're going to record the expense every year, and then they pay it back. That's like chapter 4 kind of stuff being repeated. Now we get into the thinking cap stuff, huh? Here, Burlington, this is, I'm laughing at, this is the Burlington Northern Santa Fe Railroad. They issued 100,000 of bonds at a stated rate of 10. So they're going to pay 10% a year, and they mature in 10 years. They pay twice a year, and that's important. But what the market rate is, 10%, right? So my question to you before we go to the next slide, Daniel, is this bond going to sell at a discount or a premium? Are we going to get more than 100 or less?
10% annually, 12%. It's selling at a discount.
Absolutely. Absolutely. No one is going to borrow money from us at 10% if they can go to an equally sound company for 12%. And therein lies that additional or less amount that we call a premium or a discount. Okay. Now, as we go through the first issue example here, let's see how much clicks, huh?
So okay, so it's almost like they're saying, oh, we're selling this bond for 10%, but you could easily just go get a bond for 12%. So it's almost like matching the rate.
No, not really. No, not quite. You're on the right track, though. No, we can get 12% safely right now. That's what that's telling us. This company wants to borrow money, but they're only offering 10%.
Yeah, so they'll pay you the difference.
Exactly.
So they're basically saying, we'll pay you the difference.
Exactly. The company that's issuing the bond. Yep. They're going to pay. They're going to end up losing that money right at the top, right at the front, when they only get 95,000. So let's take a quick peek here. Bonds issued at a discount. Let me just go back. Okay. Here's our calculation. The bond issued at the issue price of a bond, any bond, consists of 2 present value calculations that then must be added together. So in this case, we had a market rate of 12, and we're paying 10% per year. And I believe it was a 10-year bond for so many periods. So let's take a look at this. The market rate was 12, 2 periods a year. The bond term is 10 times 2 periods a year, 20 periods. When we go to your present value table, you notice it doesn't say year, period, because a period can be a month, a week, a year, whatever. So we're going to make 20 equal payments of, I guess, $5,000. Okay, that's nice. So the first thing we need to do, Daniel, is compute the present value of the principal, which is the $100,000 number. So we have to go to the present value table using the market rate of 12% for 20 years. And I don't know if you have the table in front of you, you should see this factor, 0.3118. You see it there? I don't know if you do or not. 311.
I don't have it in front of me, but
That's okay.
Yeah.
You know how to use the table, okay?
I do, yeah.
So you multiply that out, it comes to 31,180.
Yeah, that makes sense.
What does that 31,180 mean? It equals what?
It's the present value of the borrowed money.
Exactly right. Exactly right. $31,181 today has the same buying power of 100,000 in the future, assuming this interest rate and time period. Okay. So these two numbers are equal. You have now turned this principal amount into 31,180. And what we are going to get from the public, from anybody who buys this bond, is the present value of the bond. That's what you pay, the present value. So we know that the present value of the principal is 31,180. Now we got to do the same thing, 20 periods, 6% per period. Your annuity amount is 5,000, right, Daniel?
Right.
It was 10,000 a year, twice a year, 5,000.
Mhm.
The conversion is 11.4699 if you go to your table. So that portion is 57,350. What are we going to do with those two numbers?
You add them together.
Exactly. Good. Good. The issue price on this bond is less than the face amount, so the bonds are issued at a discount. By the way, I don't know if Cornelia or other teachers might see me say this, but if there was really a 25%, or in this case, a 20% discount in interest rates like that, the economy would be in free fall. Just doesn't happen, these big numbers, but we do that obviously to get you to understand the concept.
Yeah.
You ever hear of flash trading?
Is that like day trading?
Faster, flash trading. These big stock market firms, these big investment houses, these funds, they have powerful software where in less than a nanosecond, they see a click of about 0.1% in interest rate, and their program buys at that point.
Oh my gosh.
Then a second later, the rest of the world knows about the 1%. You know what I mean?
Uh-huh.
Yeah, flash trading. Okay, bonds issued at a discount. We know we have to pay the $100,000 back, so that's going to be our note payable. Now look at the rest. The present value of that investment, that principal, plus the annuity equals $88,530. Thus, we're going to get a check in the mail for that amount.
Uh-huh.
We have to pay back $100,000, so we're getting killed with this discount here. This discount is a contra liability account, contra liability. And we now have to amortize. How much do we have to pay at the end? 100, right, Daniel?
Yeah.
The net book value of this bond right now is only 88,000. We got to move this. We got to get this 88,530 number up to 100,000 by the end of the bond's life. And that's the process we're going to look at now. Bonds issued at a discount. Bonds issued at a discount. Here's how it's going to look on your balance sheet, huh? You're going to see long-term liabilities, notes payable, right? Bond discount, 11,470. That is the total net book value of the bond at the beginning. Now we're going to have to get that 88,530 up to 100,000 in 10 years. Two ways to do it. Straight line is one method. Effective interest method is the correct method. I think they both can be used gap-wise, but with straight line, the auditors are going to come in and they're going to redo it on their own software and compare it to what the effective rate would have been. And hopefully there's not a material difference, so there'll be no accounting adjustment. But here we go, reporting interest expense. We know the amount of the discount. We know the periods are 20, right? We know that certainly. So all we're going to do, Daniel, is take that 11,470 and divide it by 20. And that's going to be the interest expense, if you will, for every 6 months. So let's see what we have here. They issue their bonds on January 1st. The discount was $11,474, okay? I'm sorry, always with the happy thing. We divide this by 20. That's how much they're amortizing every period. So in this case, the net book value is going to rise every 6 months. So let's take a look at the presentation here. Look at your journal entry for the first year. And this is crucial. This is what we need to understand. How much do these bonds pay in cash?
Yeah, they pay the coupon rate.
The 5,000, yeah, yeah. But how much was the amortization? That was 574,
Mhm,
right? That was the
mhm.
11,470 divided by 20. We have to decrease this contra liability with this credit. So our interest expense for this 6 months is 5,574. Total interest expense, 5,000 of which is now payable in cash. 574 is the amortizing of the discount, which we're now putting into the correct period of interest. Okay, so
Mhm.
let's take a look at that. And this is the tricky part, but again, you do a couple of these and it clicks. This table here is invaluable. Invaluable. And I'm going to take us through this one a little bit slowly, and then we're going to go through a couple more with other points I'd like to make. What was the net book value when we bought the bond? We didn't get 100,000. We got 100,000 less the 11,470, right? You agree?
Mhm. Yeah.
How much was the amortization the first year, first 6 months? What was it the
It's
second 6?
574. Yeah.
It's going to be, so what's happening here? The amortization is going down by 574, 574, and it's going to continue for 20 periods until it's zero. The book value goes up 574, up 574 until it reaches 100,000. Now the net book value is 100,000 less zero discount. We pay the 100,000 and we're done.
Uh-huh.
Okay,
So
so
I'm
that's
wondering, so if it was par value, they would get 100,000 right off the bat.
if it was par value.
Yeah. The
No,
if it
no,
was
you wouldn't get 100,000 off. You wouldn't get 100,000 off the bat. You're going to get, in this case, they only got 88,530, but they still have to pay back 100,000. The present
so if
value
it
of
was
it,
par value, they would get the present value of $100,000.
which is 88,530.
Mm-hmm.
After 1 year, it's 89,104. If this was a callable bond, remember we said you have the right to cancel the bond. If they
Yeah.
canceled it after, say, year 3, they would only have to pay 92.51.
Mm.
The present value. Okay. So let's see what we got here. Now we're going into a totally different method. Totally different. But this is the preferred method. I don't think many companies, excuse me, use straight line amortization in this world of powerful, personal computers. Straight line's easier, huh? Here, the effective interest method's the one I'm really going to teach the pants off and make sure you guys get a good clue on this. The effective method, we're going to compute the interest expense by multiplying the net book value times the market rate. Let me say that again. We are going to take the net book value, whatever it is, at that point in time, and we're going to multiply it by the market rate, which in this example is 12%. That'll give us a number. The difference between that and the coupon is going to be that period's amortization. So let's take a look here. How did they get that interest expense, total interest? What is the formula? Net book value of the note, unpaid balance, if you will, times the effective rate. So the total interest in this case is $5,312. We're still just paying the $5,000. So let's take a look and see if we get a feel for this. Under this method, you are computing the total interest expense. You are taking the net book value as of year 2, year 4. In this case, it's at the start. Net book value times the market rate is your debit to total expense. Discount was amortized 312. It brought it down 1158, and you have that new net book value there. Let's take a look at the grid now. Let's see what we have here. The first thing you should notice is the payment is always the same. We never have any problem with that, hopefully. But look what's happening here. We did not compute the amortization because we didn't use straight line. We computed the total expense, Daniel, right? Total expense,
Right.
market rate times the book value.
Mhm.
We simply subtract that from the 5,000, and that's our amortization.
Mm.
So here it went up by 312. The next year, do you have a calculator in front of you? If you took 88842 times 0.12 and then divided it by 2 to get 6 months, and I'm going to do it here. I hope you have a calculator. Fun with numbers. 88842
Uh-huh.
42 times 0.12 divided by 2. I get 5331. Do you?
Yeah.
So notice the amortization went up a little bit. And notice that the discount went down a little bit, right?
Right.
Under the market effective interest rate method, you're going to have different numbers every period. In the case,
So you take
ahead.
the market percentage of the book value, you get 5,331, but then
Yep.
you go, oh, well, we only agreed to pay 5,000 a month. So then you take the difference and you make that a liability.
Exactly right, because we are reducing that contra liability down to 0 at the end of the period, and we will send out a check for $100,000. That discount, you could call it interest expense in advance in a way, right? But we can't call it interest expense because that wouldn't be proper. That interest expense has to cover the life of the bond. And that's what the amortization is all about here. Amortization in regards to a bond is changing the amortization into interest expense or a reduction in interest, okay?
So essentially you pay, I don't know, how, like 88,000 at the beginning.
You bought my bond for 88,530. Thank you.
And then in, I don't know how many, this is like
10 years.
10 years, I get 100,000.
Yeah.
So
Yeah.
I turned my 88,000 into 100,000.
Yeah. But they're really equal to each other present value wise. And that's the little thing we're ignoring in the class, which is the risk. But this is, you said that exactly right. You couldn't say it any better.
And do bonds beat inflation is, I guess, my question?
Some do, some don't.
Some do, some don't.
Some don't. You know, it depends. Again, the word risk
Depends on how fast you turn your present value into the
yeah. That could have a factor on it. Mostly though, the market determines what you're going to be able to sell your bond for. I mean, right now interest are super low, which is a bad thing for many people and a good thing for others. For you, it's good in a way because prices are kept down. For me, I can't earn any interest on money. But a company will say we want to borrow money, and the first thing any investor does is look at who the company is, what their product is, and if they're comfortable that it's a company like Apple or General Mills or one of the big cereal companies, if they're paying a little more than the market rate, well, you would grab that higher market rate only because you're comfortable with that company. If not, you would go to the market rate from a safer company.
But if you wanted more money, you might buy a riskier bond.
Exactly. And if you want, I could give you my broker's phone number right now, and he could hook you up in Merrill Lynch to what they call, I don't think they call it a junk bond fund.
Yeah.
Or they have a fancy word for it. Try not to sound negative. But yeah, that's a fund that trades just in what used to be called junk bonds, bonds that pay a super high rate of interest. And you're trusting that fund to know when to get in and out of these different companies, knowing some of them are going to fail. While they're in there, you're going to earn a lot more interest. But man, the risk would be really high.
I see.
Okay. And there's another truism of the stock market. I'm back in the stock market. Everybody knows when to buy. Nobody knows when to sell. Just remember that. Okay. The interest. We'll talk briefly about zero coupon bonds. Zero coupon bonds are just this. They don't pay interest. I'm telling the world, I want to borrow $100,000 and I want you to pay me 100,000. And based on the market rate, the present value of that bond might only be 90,000. Okay. So you pay me, how do I want to explain this? Zero coupon bond means there is no cash payment made, just the payment at the end. The issue price is going to be the present value of the principal. And because there's no interest being paid, you usually get a higher interest with a zero coupon bond. In other words, we issued that one bond for 88,530, right, Daniel?
Uh-huh.
With a zero coupon, you might have to pay a higher, you have to sell it at a deeper discount. So you won't get 88, you might get 78. Zero coupons, I never hear anybody talking about them in my world. Not that I'm always talking to, Merrill Lynch or anybody. Okay, we just went through a discount. Our interest rate was unsatisfactory compared to the market. Now we are talking about a premium. Our market rate is 10% still, but the market rate is 8%. Hooray for us. We're going to get more than $100,000. So the issue price, again, we have to get the present value of the principal, the present value of an annuity, add them up, and that's how much money we are going to get from the lender. Remember now, you always use the market rate when you go to the present value tables, never the coupon rate. You know what happens if you use the coupon rate by mistake, Daniel? You'll come back to $100,000. Okay, so you use the market rate. Don't waste time thinking about the coupon rate. Okay, so again, we have the same 20 periods, but this time it's not 10, it's 8%. So look at this. The present value of the principal 100,000 is 45,640. That means we must have $45,000, 640 in the bank today in order to have 100,000 in 20 years, if you want to look at it that way. It means that the buying power today of 45,640 is equal to 100,000. You wanted to buy that nice car for 45,640, and you put your money under a mattress for 10 years, then you go to Perry Lincoln, you're not going to buy that car for 45,640. We know that, huh? Excuse me, the present value annuity. Well, the annuity is still $5,000 because we're going to 4%. We multiply it out. That's the present value of the annuity. We add them together. Wow, look at that, huh? We're going to get a check in the mail for $113,592, and we only have to pay back $100,000 in 10 years. Okay, that's how the math works. Again, these differences of 2%, whatever, they're really huge compared to normal business, but this is the way it has to be taught. So our journal entry is going to be what? It's going to be a debit to cash. It's going to be a credit to accounts payable for 100. And here's the presentation. 100,000 bond payable plus the premium. So the net book value at the beginning is 113,952.
So if you decide to buy a bond at a premium, you're getting a slightly worse deal.
No. Because everything is being discounted back to the market rate in our example here.
Huh.
Now, where the difference comes is in the risk. You buy a bond for $100,000 and you get, and you get 5% and they pay you back 100,000. That's just a simple, the market was in equilibrium, I guess you could say. Market rate equals the coupon rate. But no, companies, assuming they're happy with the market rate, are going to have to pay you 113,592 to get what the market rate really is. They're paying you more to get the market rate. We're trying to equal this out. The market rate in this case is lower, so we're going to get a check in the mail for $113,592. And you were happy to give me that money because the present value of that is $113,592. And when you get paid back the $100,000, you got a pretty good deal. And we can talk about the marketing of these a little more if you like, Daniel. But our chapter is taking everything back to equilibrium, everything back to the market rate. Okay. Now let me point this out. As you know, you can always sell a bond just like you can a stock, right? During the period of the bond. So you have a bond that pays 4%, and the market rate goes down to 2%. Suddenly people are going to go crazy to buy your bond to get to 4%. Straight line. Okay, straight line, 20 periods, 13,592 premium at the beginning, divided by 20 is $680. And there we go. You're going to write the same exact journal entry 20 times. You can go into your computer system right now, and if it lets you go into future periods, you can say, wow, I got this bond booked already through 2026. Because it's straight line, right? Straight line. You start off with 113,592. And now it's going down by 680, down by 680, down. The premium is going down. It goes in the opposite direction of a discount. And some of the multiple choice questions that I've seen over the years here are along the lines of true or false. If the amortization decreases during the life of a bond that was sold at a premium, and the answer would be yes. And that can be a confusing question depending on how they answer it. So you're pretty good with this grid now on how it works, huh, Daniel?
Yeah.
Okay. Let's go back to the proper method. Again, our formula is net book value, which in this case is 113,592, times the market rate of 8% or 4% per 6 months. And we come up with a number of 4544, right? Okay. Now we're ready to amortize the bond. Let's amortize. Well, we know we're paying the 5,000. We just computed the first period's amortization right here, 4544. And there is our grid. Not too tough if you understand the difference between the coupon rate and the market rate. And you understand that the coupon interest payment is the annuity amount, and it never changes, never, during the life of the bond. The straight line amortization method is inferior, but easier to understand, right?
Yeah.
This method here, you have to understand that the formula for interest expense is net book value times the market rate. That's where we got the interest expense. We know we're paying 5, and here we're debiting that liability account called a premium. Okay. Here's our table. I don't like that thing. I think we're getting toward the end here, Daniel. They talk about early retirement of a bond, okay? So you want to retire your bond, say, in the middle of the period, you're going to have to pay the net book value and maybe a little bit of cost on top of that. So I'm not going to get into that too much. This is not my class, and I'm using my slides. You know, Carolyn may have different emphasis. I'm not sure, but I'm laying out the basics, kind of as best I can here. And Excel, you big Excel user, Daniel? No, not yet.
No.
Okay, you will. I don't care what type of work you do in your future. If you're in business, you'll be using Excel. If you work in academia, you'll be using Excel. If you're a shepherd, you'll be using Excel to keep track of things, okay? So that's the presentation of chapter 10. May I ask for questions or any comments, anything you want to see again?
I guess my final question is just, so at the end of it all, no matter what, whether it was a premium or a discount or par value, the bond is worth the same at the end.
Yeah, $100,000, yeah.
It's just you go about differently. Like if you paid extra for it,
Yep.
then it decreases in value as it gets to 100,000.
Not in value, in what's called net book value. Net book value. It may not have anything at all to do with the market rate. I mean, it may not actually have anything to do with the market rate, except at the beginning, because that's where we loaned or borrowed the money. In other words, after 3 years, what if the market rate went up to 6% instead of 4%? Well, if you're stuck with this bond for the next 10 years, you lost out on some extra interest, obviously, right? But if you could sell the bond, if it's callable, you'd call it in and reinvest at the higher number. So bonds are interesting. Bonds are, I mean, I would never give investment advice. And if I ever suggested a stock for anybody, they should fire me here. All I'm saying is bonds are, typically more for older people. It's a conservative way to generate cash in retirement. Over any reasonable period of time, stocks, a decent stock portfolio will outdo bonds, okay? But that's up to you. It's all about risk tolerance, right? If you're the type who is going to look at what your 401k balance is every day, then maybe you don't have the stomach for stock, which take a little more risk. But I'm digressing here. What do you think? Anything else?
No, I think that's good. I feel better about that.
Okay. All right. I think we had a good session here. You and me, we kind of, we got the class something to look at. And I'm hopefully, I don't know if Karen will be back next week and you'll see your regular teacher. In the meantime, you have a good week there. Okay, pal?
All right. Thanks. You too.
And thanks for the help on the sharing the screen. It's invaluable.
All right. Bye.